a $4,200 yearly loss looms for homeowners. The Dallas Fed president's recent statement on higher interest rates has sparked concern among homeowners. With the current 30-year mortgage rate at 6.55%, any increase could significantly affect borrowing costs. But what does this mean for your wallet? A 0.25% increase in interest rates could raise the 30-year mortgage rate to 6.8%, resulting in an additional $124 per month on a $300,000 mortgage. For a homeowner in California, this could mean an extra $1,488 per year. And for those in New York, it could be $1,676. But it's not just the direct costs that are a concern. Higher interest rates could also slow down the housing market, affecting home prices and sales. For example, in 2006, when the 30-year mortgage rate rose to 6.41%, home sales declined by 8.5%. Back in 2008, a similar increase in interest rates led to a 12% decline in home prices. Additionally, a rise in interest rates could lead to a decrease in home affordability, making it more difficult for first-time homebuyers to enter the market. For instance, a $400,000 home with a 20% down payment would require a $320,000 mortgage. With a 6.55% interest rate, the monthly payment would be approximately $2,024. However, with a 6.8% interest rate, the monthly payment would increase to $2,149, making it even more challenging for buyers to qualify for a mortgage. Furthermore, let's consider the example of John and Mary, who purchased a $500,000 home in 2020 with a 30-year mortgage at 4.25%. If interest rates rise to 6.8%, their monthly payment could increase by $433, resulting in an additional $5,196 per year. This highlights the importance of considering the potential impact of rising interest rates on mortgage payments. So, what can homeowners do to prepare? The potential $4,200 yearly loss is not just a hypothetical scenario. For a homeowner with a $400,000 mortgage, a 0.25% increase in interest rates could result in an additional $208 per month, or $2,496 per year. And it's not just the mortgage payments that will be affected. Higher interest rates could also increase the cost of home equity loans and lines of credit. For instance, a $50,000 home equity loan with a 6.55% interest rate could cost $318 per month. But if the interest rate rises to 6.8%, the monthly payment would increase to $331. Furthermore, a common misconception is that homeowners can simply refinance their mortgage to a lower interest rate. However, this may not always be the case, as lenders may have stricter requirements for refinancing, such as a higher credit score or a lower debt-to-income ratio. For example, a homeowner with a credit score of 620 may qualify for a 6.55% interest rate, but with a credit score of 680, they may qualify for a 6.3% interest rate. Additionally, consider the case of Sarah, who refinanced her $300,000 mortgage from a 5% interest rate to a 6.55% interest rate in 2022. She experienced a $145 increase in her monthly payment, resulting in an additional $1,740 per year. This example illustrates the potential consequences of rising interest rates on refinancing. So, how can homeowners mitigate these costs? One strategy could be to consider a mortgage recast, which can help reduce the monthly payment by extending the loan term. Another option could be to explore alternative loan programs, such as a 15-year mortgage, which may offer a lower interest rate and lower monthly payments. Historically, we have seen that when interest rates rise, homeowners who have adjustable-rate mortgages are more likely to refinance to a fixed-rate mortgage, which can provide more stability and predictability in their monthly payments. But the part that surprised me most is how this affects your ability to refinance. And I'm going to share a real-life example of how one homeowner was able to save thousands by refinancing at the right time. You'll learn how they navigated the refinancing process and the specific strategies they used to minimize their costs. This is a crucial section that can help you avoid common pitfalls and make informed decisions about your mortgage. That's next, and it's a game changer for anyone considering refinancing in the near future. With interest rates on the rise, refinancing a mortgage may become more challenging. For example, a A homeowner who refinanced their $300,000 mortgage from a 4% interest rate to a 6.55% interest rate could see their monthly payment increase by $341. But what if they could refinance to a 6.3% interest rate? That would save them $114 per month. However, with the potential for higher interest rates, lenders may become more stringent with their refinancing requirements. Back in 2018, when interest rates were rising, many lenders began to require higher credit scores and lower debt-to-income ratios for refinancing. For instance, a lender may require a credit score of 700 or higher to qualify for a refinance, whereas previously they may have accepted a credit score of 680. Additionally, a second-order effect of rising interest rates is that it may lead to a decrease in the value of mortgage-backed securities, which could impact the ability of lenders to offer refinancing options. Furthermore, consider the example of Michael, who attempted to refinance his $400,000 mortgage in 2020 but was denied due to a high debt-to-income ratio. He was able to improve his credit score and reduce his debt, and eventually refinanced his mortgage to a lower interest rate, saving him $250 per month. This example highlights the importance of being proactive and taking steps to improve your creditworthiness. So what are the implications for homeowners who are considering refinancing? One strategy could be to consider a cash-out refinance, which can provide a lump sum of money that can be used to pay off high-interest debt or make home improvements. Another option could be to explore government-backed loan programs, such as an FHA loan, which may offer more lenient refinancing requirements. Historically, we have seen that when interest rates rise, homeowners who refinance to a fixed-rate mortgage can save thousands of dollars in interest payments over the life of the loan. But there's a silver lining for homeowners who act now, and I'm going to reveal a strategy that can help you come out on top, even in a rising rate environment. You'll learn about a little-known technique that can help you reduce your mortgage payments and minimize the impact of rising interest rates. This technique has been used by savvy homeowners to save thousands of dollars, and I'll explain it in detail in the next section. It's a contrarian approach that few people are talking about, but it could be the key to saving thousands of dollars in the long run, and I'll explain it in the next section. While higher interest rates may seem like a doom and gloom scenario for homeowners, there are potential opportunities to be found. For instance, a rise in interest rates could lead to a decrease in home prices, making it a more attractive time to buy. Additionally, some homeowners may be able to take advantage of higher interest rates by investing in bonds or other fixed-income securities. Back in 2013, when interest rates were rising, many investors turned to real estate investment trusts, REITs, as a way to generate income and diversify their portfolios. For example, a $10,000 investment in a REIT could generate an annual income of $500, providing a 5% return on investment. Furthermore, a common misconception is that rising interest rates are always bad for homeowners. However, for those who have a fixed-rate mortgage, a rise in interest rates could actually increase the value of their mortgage, making it more attractive to potential buyers if they decide to sell. Moreover, consider the example of Emily, who purchased a $300,000 home in 2019 with a 30-year mortgage at 4.25%. If interest rates rise to 6.8%, the value of her mortgage could increase, making it more attractive to potential buyers. This highlights the potential benefits of having a fixed-rate mortgage in a rising interest rate environment. So, how can homeowners navigate this complex environment and come out on top? One strategy could be to consider a tax-efficient investing approach, such as a 1031 exchange, which can help minimize taxes and maximize returns. Another option could be to explore alternative investment vehicles, such as a real estate crowdfunding platform, which can provide access to a diversified portfolio of properties and potentially higher returns. In conclusion, the potential $4,200 yearly loss for homeowners is a significant concern. To mitigate this, consider reviewing your mortgage and exploring options for refinancing or investing in other assets. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about interest rates, hit subscribe. I break down one of these every week. And as a final takeaway, remember that rising interest rates can be a wake-up call to reassess your financial situation and make adjustments to ensure you're on track to meet your long-term goals. So, Take action today and start building a stronger financial future for yourself and your family. Specifically, consider the following steps. Review your mortgage statement, check your credit score, and explore refinancing options. By taking these steps, you can better navigate the challenges of rising interest rates and make informed decisions about your mortgage. Don't wait until it's too late. Start taking control of your